All right, so you've heard me talk about technical analysis, and you have a basic understanding of what that means. But let's overlay this into our bread and butter, which is looking at charts. I'm sure you guys have heard the term indicators, all right? Everybody's always talking about their magic indicator or this or that. There's no such thing. But what we do with our charts and combine it with what we know about just pure technical analysis is we put all of this together so that we can make trading decisions. So charting is a graphical format for all buyers and sellers. But on that chart, beyond just listing price, I do use a certain group of indicators that are all combined to find momentum and trends. So I have a specific group of indicators that I believe is the best combination for trend analysis. So let's take a look at what actually goes on in a chart, and then I'll show you like what all these indicators do and mean and how they interact with each other so that we can make some trading decisions. So as we said, charting is a graphical interface, but on the chart, it just looks like a giant Picasso painting. So what the heck is all of this on a chart? So let's talk about what's on a chart and what the heck all these indicators and graphics do and how they interact with each other so we can make proper trading decisions. So the first thing that goes on a chart, so we got a blank chart here. The first thing that goes on a chart are candlesticks. Candlesticks are just a representation of price action for a particular day. So right now we're taking a look at VUSI. VUSI is a stock that I've been trading non-stop since it was just a few bucks. But what the candlestick for today means is the range that the stock actually traded today. So when you have a candle, a green candle means that the stock is up for the day. A red candle means that the stock is down for the day. So pretty simple. Now, when you have a candle, the range of that candle represents the high and low of how much that stock moved throughout the day. So if we look at a candle for today on VUSI, what do you notice? So today we have a red candle, and you can see the stock is down 12% today. What the top of the candle and the bottom of the candle mean is the high and low of today. Now, on the other side of things, when you get a green candle, it's the opposite. The stock is up for the day, and then that high and low is from where it started to where it ended. Now, after candles, what we want to overlay on our charts, and this is really the most important indicator we can use, is volume. One thing that I want you guys to know about indicators. Indicators are never used to judge whether you should buy or sell a security or a stock. Indicators are used strictly for confirmation of price. So what does that even mean? When we think about trading, I want you to think of yourselves as lawyers. You're building a case of why you should put your hard-earned money, right? Money that you could be spending on something else, into this stock. So what we want to do if we're going to be effective traders is build a case for every investment and every trade that we make. We're lawyers, and we want to prove beyond a reasonable doubt that a stock is worth our time, our investment, but also our mental capital. As you probably know, when you're making a trade or putting money in anything, it's kind of stressful, right? So we want to make sure it's worth our time, our money, but also our mental capital, which is frankly sometimes the most important thing. So how I want you to think of every single trade. When you have a trade or an opportunity in a particular stock, it's always a 50-50 shot. For most people, frankly, taking an investment or a trade is a gamble. It's a coin flip. You might win, you might lose. You buy, you sell, stock goes up, stock goes down. But you can't really build any consistency or a long-term track record from doing it that way. How you can actually do those things and make a career out of this, or just a nice run for your investments, is you build a case for every single stock that you look at. So we know that a trade is a 50-50 shot. But how you take it beyond that is, first of all, you look at price. When you look at those candlesticks, a grouping of candlesticks can show patterns. I'm going to show you a couple patterns in the next class, but I want to talk to you just about a simple one that I use right now. So if you look at the chart of VUSI, so if you look from January 25th to February 16th, there was a lid on that particular name, right? And when you got over that level, price exploded. So that pattern itself is just called a flag pattern. So when you look at a grouping of candles, what we want to first do is figure out, do I have a pattern? And there's a lot of patterns you can trade. In my 60-day boot camp, I teach 18 patterns between day trading, swing trading, and longer term investments. So this one's called a flag pattern. So okay, you have a pattern. Now what you want to be doing is overlaying your indicators to give you probability that that pattern can be effective. That's all indicators are. They're not there to tell you what to buy or sell. Only price and the price pattern can do that. But what those indicators can do is tell you, can we move the needle from something that's a 50-50 shot to something that's higher probability? So you got a coin flip, now you've got a great price pattern, guess what? Those odds go from 50-50 to 60-40. Now you start overlaying your indicators, you might go from 60-40 to 70-30. And if they all line up perfectly, now you've got yourself something that's a sure thing. So the most important indicator that we use on a chart is volume. Volume is the emotional intensity of a stock. It's a measure of how many traders actually want a particular name. So when you look at your chart and you have your candle, underneath that candle is a listing of volume. What it's going to tell you is how many shares of that stock were traded that particular day. So underneath your candle, you're going to have a number and also a candle. And it's going to tell you how many shares were traded. Well, why is that important? Well, the more volume in a stock, the more powerful it can be. Volume is the emotional intensity of a name. What it's going to do is tell you how bad traders want that particular name. So when you see a stock explode, like this TCAT, and it goes from a few dollars to $70, what do you notice about that volume? It goes from just a few 100,000 shares a day to doing 10 million, then 20 million, then 30 million. What it's telling you is that everybody's clamoring for this stock. That expansion in volume provides the fuel that you need to get a stock moving. And that's what we need when we look at volume. The second part of volume that's really important is just liquidity. Liquidity. So what is liquidity? Liquidity is how easy you can get in and out of a particular stock. If you think about any investment, liquidity is important. Can I get rid of this thing in a jam if I need to? Well, if you have a stock that's got low volume, and for me, I think anything that does less than 1 million shares a day is low volume. If it's got low volume, it means if I have to dump my shares in a hot second, there's not going to be any buyers there. If you have a stock that's doing 200,000 shares a day in volume, well, that's only a few thousand shares an hour. So if you got to dump your shares, there might not be actual buyers there to take your shares at the price you want to sell. But when you have a high liquid name, a stock that does millions of shares in volume, then at any given price point, if you need to sell, you're going to be able to get out of your trade. And frankly, that's really important. You never know, right? When you need to get out, you need to get out. Let's talk about the next most important indicator, moving averages. I use these every single day. Moving averages are these squiggly lines on the chart. Now, what moving averages do we use? I use a 9 EMA, a 20 SMA, a 50 SMA, and a 200 SMA. So now what the heck did all these things do? Moving averages serve two purposes. Number one, moving averages can tell us about trends on a specific time frame. What does that even mean? So your 9-day moving average is just the average price of your last 9 days. So if your 9-day moving average is pointing higher, then the trend for the last 9 days is higher. If the slope of that moving average is down, then the trend for that last 9 days is down. So why would that be important? Well, if you're a short-term trader and you're buying a stock and you want it to go up and your 9-day moving average is down, then you're trading against the trend. What the probabilities and statistics tell you is that if you're buying a stock and you're planning on holding it for 3 or 4 days and your 9-day moving average is down, majority of the time you're going to lose money because you're a trend trader. In essence, everything about momentum and trend trading is about trading with the trend. Guys, the biggest losses in my career, I got nightmares from them. The biggest losses in my career have always been from trading against the trend. When I see a stock that looks cheap and I buy it, what usually happens when that happens? What usually happens when you see that? It gets cheaper and cheaper. So many times in my career, I've seen a stock that's like $100 or $50 and it's dropping and dropping and dropping. And here I am thinking like, oh wow, this is a great deal. Well, in trading, it's different than if you're at the supermarket. Cheap gets cheaper. A stock that's dropping and gets cheap is usually doing it for a reason. The lowest risk, highest probability trade, the lowest risk, highest probability trades are those in the direction of the trend. When you're trying to go and get a big runner, I'm talking about stocks that can move 20, 30, 40, 50% in a short period of time. All of those type of trades that are low risk are always in the direction of the trend. So understanding moving averages is huge because your moving average is going to tell you the direction of the trend on a particular time frame. So your 20-day moving average and your 50 are your intermediate term trends. So if you're doing a trade that's maybe going to last a couple weeks or a little bit longer, you want to be trading in the direction of that trend. And then of course your 200, that's your granddaddy, that's your longer term trend. Your 200-day moving average signifies your 1-year trend. So if you're looking at a stock like say Apple Computers and you're wanting to add it to your 401k or maybe your IRA and you're thinking like, I'd love to hold this for like a year or two. And that 200-day moving average is pointing down. What it's telling you is that your 1-year trend is actually going down. So what are the odds that when you buy it, it goes the opposite way of the trend? Statistically, it's very little. I mean, under 10%. So we always want to be trading in the direction of the trend for our goals and our hold times of what we're trying to accomplish on a particular name. Now, the second part of moving averages can be bounce spots, meaning that stocks that are trending, when they pull back to certain moving averages, those can actually be load zones where you can buy a stock with a very low risk opportunity and continue on with that trend. So moving averages can be awesome bounce spots where you can get into a stock and it explodes off of it. They can be amazing support plays with really low risk. Let's take a look at one of my favorite stocks that I've been trading back and forth for months now, Riot. On February 10th, this stock pulls right back to its 9-day moving average and then explodes off of it. Within days, it's moved up 10 points. When you have a stock that's got big momentum and it does its first pullback to that 9-day moving average, that is often a great buy spot where you can purchase a stock and have it keep going. Now, we don't just buy stocks because they hit moving averages. Otherwise, we'd all be bajillionaires. Remember what I said. We're lawyers. We're building a case. So beyond just, hey, a stock pulls to a moving average, we buy it, we need a price pattern. Then we need our volume to confirm. And then when we have our moving averages supporting those, that's when you've got the perfect storm and you've got a buy spot where you can get into a trending name on a short-term pullback that's going to continue on. The 9-day moving average is a great bounce spot that I've been using on so many trades in this hot trending market of the last 6 months. Let's take a look at one of my favorite cryptocurrency coins. This was one of my biggest trades of the year in cryptocurrency. This chart on DOT. This has been one of the hottest coins in the whole market. So what you can see is in January, DOT had been just in hibernation and it started to explode. And it got all the way to $8, $9. Now on January 21st, that stock had a just very orderly pullback to the 20 SMA. They've been pulling back for a good week or so. Once it starts to hold there, and you get a green candle to hold, meaning it holds there for a day, it gives you a signal that that level is holding true. And that can be the buy spot for the next potential run. I loaded this thing up on January 21st, and it was a straight shot into the 20s right after that. I love moving average pullbacks as long as the rest of my case confirms. Guys, hopefully you've learned something about technical analysis and charting. This charting format that I've been using, I've been literally using it since 2008, making trades based off of it. I've owned this business since 2008, and I've taught thousands of traders how to set up their charts and make trades using the same graphical format. I hope you guys have as much luck with it as I have. Now, on the other side of things, if you want to learn a little bit more about trading, something a little bit more in depth, maybe some patterns, maybe risk management or scanning and software, I've got a 60-day day trading boot camp that is designed to take people from A to Z on everything that you need to know about trading. It's 60 days for a reason. Trading is a job. I've been doing this my whole adult life. It's my life's passion. But it's a job no different than a doctor, a lawyer, a teacher, an engineer. You got to go through that same process. You don't just watch a couple YouTube videos and think like, hey, I'm a trader. There's a process to it, but there's a lot of information to learn. Now, it doesn't mean it's impossible or even if it's that hard, but it does require some work. And so I got a 60-day boot camp that's live via webinar. They'll take you from a dead beginner to somebody that will have an acute understanding of the stock market, but also a statistical edge when they deploy money so that they can have some profits. I teach my classes live. But I know a lot of you guys got jobs. So every class is recorded and archived. I give my students lifetime access. So you can come into live class for life. And we go through charting, price patterns, risk management. All this software you see back there, it looks daunting, right? It's not. It costs $30 a month. It's called TC2000. I give you guys all my layouts, all my scans and everything that you need to get started. You don't even have to set it up. When you sign up, you'll have all these tools at your disposal on command. So if you're not good with computers, and I'm terrible at computers, you're good to go. Now, if a 60-day class is not something that you have time for, and it is a little daunting, I totally get it, I've got an accelerated trading course. It's a 20-hour recorded course. You can go through on demand, learn the things that you need to do so you can get started on some short-term swing trading and also day trading. I'm going to show you 4 patterns in depth so that you can go out and actually duplicate those patterns. But beyond that, you have access to my trading chat room. So when you take the accelerated trading course, you get my trading chat room with it, where you can watch me trade live every day, where you can learn and earn and follow in real time how a real trader goes about his day. Guys, I hope you enjoyed yourself. If you ever have any questions, email me anytime you want. My email address is kunal@bullson.ws, or text me or call me. Number is 517-974-1480. That's my personal cell. You guys are more than welcome to reach out to me. You'll be shocked. You hit me up, you might be getting a FaceTime from me at some random hour, but I'll always get back to you. This is my life's passion. I look forward to teaching every single one of you guys how to go out, get your goals, make some money in the stock market, and do whatever it is that you want to do in your life. Take care.